Hi guys, so let's now have a look at perfect competition and consider a scenario where we've got a firm which is making supernormal losses within an industry, and then we'll look at a scenario where a firm is making supernormal profits. Okay, so you can see here I've got an industry diagram, here I've got a firm diagram. We're going to concentrate on these two firstly within considering this. Now imagine the situation where you have firms which have no barriers to entry or exit from the marketplace who are making supernormal losses. Okay, so we can see the current price and quantity level within the industry. Let's just take that price level across now. As we do so, we can then join that all up. Okay, so let's just join that up and call that the demand equals AR equals MR curve. So there it is. That's our demand curve situation at the moment. Now, the key situation that we have here is the fact that average cost is beyond, greater than the average revenue. So here is our average cost curve. Okay, so we've got our average cost curve. Let's just put in our marginal cost curve as well, so we can see our marginal cost at this level. Now, as such, the firm would actually look to minimize losses by producing where MC equals MR, because not only is that profit maximization point, it's also a loss minimization point, okay? And it ensures that your marginal cost doesn't then go beyond exceeding the actual marginal revenue gained at least. So you can see that that would actually be the level of output that would be derived in this situation, and you may choose to go on to actually label that. Now, in the scenario where you have no barriers to exit, of course, you would have firms then leaving this marketplace. As they leave this marketplace, we would see a shift in the supply curve to the left, and we can see that there. Therefore, we notice that the price level rises and the quantity falls. Okay, so we got P2 and Q2 now. Okay, so as a direct consequence of this, we can take this line across, and what you will now see is we're going from P1 to P2 here, and as such, we now reach a new demand curve. Okay, so let's just call this D1 now. D1 equals AR equals MR. Right, so nice and straightforward there. As such, we can now see a situation where the long run equilibrium situation of normal profits is restored, and let's just label that up as Q star, because that would be a long run economic output. Average cost now equals average revenue, and hence the firm is making normal profits and the market is now stable. Okay, so that's an interesting example to consider, where of course you would have firms leaving the marketplace. Remember that key assumption of no barriers to exit, and therefore the supply curve shifting to the left hand side, and that supply curve shifting to the left means that less supply means the price goes up. Okay, and you may choose to actually highlight that. Let's just do that with a different color pen, so you can really show that that demand curve has now shifted up. Okay, great stuff. So let's move it on. Let's now have a look at a situation of supernormal profits, okay, in the short run. So now let's just label up our demand and supply curve as we did before. Okay, so there it is. We'll label that Q1 and P1. Okay, so we got P1, Q1. Excellent. Let's now take that line across, and we can see that nice and easily there. Okay, and I'll just label that D equals AR equals MR as well, because we know that's our starting point. Now, remember the key situation with supernormal losses is that here we were dealing with a situation where the actual average cost was greater than the average revenue. Here it's the other way round, of course. Average revenue is greater than average cost. Okay, so let's put in our average cost curve, and we know this average cost curve is below our average revenue, and we can see that there. Okay, let's just highlight our price level, which is currently a P1. Okay, and now let's put in our marginal cost curve, and make sure that that again goes through the bottom of the average cost curve, because remember, the marginal cost is either pulling down the average or it's pulling it back up. So that's an important point to be aware of. You can see at this level, the firm would be producing an output level there, okay, where MC equals MR, because they're profit maximizers, of course. Okay, so as such, you would then be able to take this line down to this point here where average revenue is and highlight, let's just do that, highlight the area of supernormal profits that's actually being made here. So let's just highlight that just to give us a little bit more analysis material that we can use. Now, what's significant, of course, is that there's no barriers to entry. As there's no barriers to entry, other firms would be tempted into this marketplace. So imagine perhaps that eggs become very expensive and you're able to profit from keeping chickens. This is a nice example to consider in such a market, because suddenly you'd have more people buying chickens so that they could sell eggs, and in doing so you can see that the actual price of eggs would end up having to shift downwards, and we can see that here. There it is, that the price level now needs to go down, and we can see the points where MC equals MR, which would now be here, and there we go. That is our long run equilibrium restored, where now once again average costs equal average revenue, and we see that this demand curve has shifted downwards. Okay guys, I hope that's useful for you there. This is really useful analysis in terms of understanding the actual impact of new entrants into a marketplace, okay? So if you ever get a question about the threat of new entrants, this is great stuff to actually look at, as well as market contestability and limit pricing, which we'll look at in another lesson coming up. Great stuff. See you next time.